to today's presentation. MGIC celebrates its 60th anniversary this year. We have been the first name in private mortgage insurance since 1957. With so many years of experience and expertise behind us, we are pleased to share ideas, information, and tools you can use to be more successful in today's dynamic mortgage marketplace. It is my privilege to pass the controls for today's presentation to MGIC's customer trainer, Rebecca Chase.
Great, Greg. Thank you ever so much, and good afternoon, everybody. Thanks for joining us. Greg, as he mentioned, is going to be monitoring anything and everything that we all might need help with. So if you have any technical needs, go ahead and reach out to him, as well as if for some reason you can't remember where the link to get to the session materials were, Greg has already gone ahead and put that into the chat panel for us. So again, we're going to talk about what this whole process is about. And one of the things that's easy to have happen when you start working in the mortgage industry is that you get involved in being really, really busy and dealing with file after file, and many times don't really have a chance to kind of step back and look at it from 50,000 feet about how this whole process works, why we do the things we do, and how all the inner workings, both internally and externally, are connected in order to successfully originate a loan, sell it, and then start that process all over again. So we're going to take a walk through that for the time that we're together. We always start our sessions with a general reminder that we're going to talk about a number of different things, certainly not in enough depth for you to feel that that would be the basis for your decision. Utilize your own internal guidelines. So this is what is on the agenda for today. Lots of information. Again, as you look at that and you see that we're going to get into taking a closer look at income, assets, appraisals, et cetera, we do also offer some additional sessions on those topics individually that will dive a little bit deeper into that. So what this whole process is about, and again, we all work in various different environments because we have a large size group that is representative of all over the country. And some of us work for financial institutions and are therefore in more of a retail environment. Some of us work for lenders that may sell directly to the secondary market, such as Fannie, Freddie, FHA, or they may sell in between and utilize a correspondent, another lender, as that access to the secondary market. Again, however it ends up, we also have to stop and think about how does it start out? And it really starts out with a consumer needing assistance in the financing of their home. And let's never forget, if consumers could get into their home without needing a mortgage, most of them would certainly choose to do that. So we want and always need to realize that we are playing an important role in a big piece of people's lives. It's typically the largest obligation or loan that they'll take on, but they also come to the mortgage process and the application to closing with a little trepidation. So again, the more that we understand why and what we're being asked to do in whatever our current role is in that cycle, the better off we're able to assist then our customers. So we start with the origination. And again, that might be a loan officer, it might be a loan originator, there can be a number of different titles that they might wear, but it's the interaction initially with the borrower in terms of deciding which programs best for the borrower and then getting that whole process started. Along with that, we may have loan officer assistance, there may be credit analysts, but from there we enter into starting the process of determining whether this is a good quality risk for us as a lender, because that's what mortgage lending is about, is evaluating risk and making decisions whether we can tolerate that risk. We would love to approve every single loan. Certainly, we'd make borrowers happy, we'd make employees happy, and we'd make our daily lives a lot easier. But the reality is that when we're working with a risk-based decision, even though we may have guidelines that we kind of use to drive us through the process, we have to remember that we're going to individually evaluate the risk within each borrower's file because no two of us are identical. From the origination point, we move either into processing and then underwriting, and some of our customers will go underwriting and then processing. Those three pieces of the process are very closely tied, and one is not any more important than the other because, again, in order for us to make the best risk decision, we've got to take the borrower story, which we pulled together on the loan application, and verify it with third-party evidence. One, to make sure that we're relying on good, solid information, and two, that when we do sell that loan into the secondary market, or even if you put it in your own portfolio, that we have made that decision based on valid information. So the processing and the underwriting piece of it is all about taking the borrower story and confirming it, trusting but verify. The happy days are the closing days when the borrower successfully, if it's a purchase transaction, gets the keys to the house and goes on their merry way. From there, the process is not done because we want to be able to lend that same money to another consumer. So that's what happens after the loan is closed. Either we'll put the loan in portfolio, and that you typically see more commonly when we're working within a financial institution or credit union walls, or we may sell that loan out into the secondary market. Fannie, Freddie, an end investor that is going to purchase it, they're going to pay us back the amount of the mortgage so that we can lend it out again, and then that secondary market is going to package those mortgages and offer them out to the investment community as an investment vehicle. Along the way, somebody's going to have to collect the payment. So the last piece of this process is who's collecting the borrower's payments? Not only the principal and interest, but for many borrowers, if they're including their taxes and insurance and other costs within their monthly payment, that servicer is also going to be responsible for that. There are companies out there that do nothing but service loans. So again, each part of the cycle has vendors and players in that are very specially set up to handle their piece of the puzzle. Folks that are involved, certainly we've got borrowers. We already talked about a lot of different lenders. In that investor column, it can be the governmental agencies that we are so commonly here referred to all the time, Fannie and Freddie. It could be the individual banking institution that you work with. And then again, like we talked about, it may be investment companies that are purchasing blocks of mortgages. There's also all the specialized players, the appraisers, the title companies, the closing attorneys, your mortgage insurance friends, et cetera, et cetera. If you sat down and tried to put together how many people touch a mortgage file before we actually get it all the way through that circle we just looked at, it can be upwards of 50 to 60 different touches. So it's a complex process that everybody plays an important role in, and understanding how it all fits together just makes it a little bit better foundation for us. So what we loaded here on the slide are a lot of acronyms, and of course the mortgage industry, like so many, loves acronyms. Regulation is a huge part of our industry. One, borrowers are taking on a financial responsibility to repay. They need to understand the terms. We need to make sure that we're protected in terms of repayment, but we also need to be able to demonstrate that we're following specific guidelines to ensure that all folks' information is being taken care of, to make sure it's privately held, as well as we're fairly taking care of folks. So it's one thing if you're brand new and you're simply trying to get familiar with the acronyms as they stand now. It's another thing if you're joining into an organization where there's a lot of seasoned people who are talking about all the acronyms like they used to be. So it can be a real challenge, and that's one of the things that you always want to continue to expand your knowledge and understanding of why we have these regulations and what the details are about the specifics. And again, this just gives a little bit further breakdown of what some of those acronyms are. Again, some of them apply no matter what type of credit we're applying for, whether we're looking to get a credit card or whether we're applying for a car loan. There is some protection that is similar with these guidelines as it relates to any type of lending. Back in 2007, 2008, when everything kind of imploded and we saw the economic issues as well as the mortgage industry issues, there was a large piece of legislation passed known as the Dodd-Frank bill. And we certainly are seeing continued conversation about the Dodd-Frank bill, and it's not even yet fully been enacted. Within the umbrella of that act, it created an organization known as the Consumer Finance Protection Bureau, commonly referred to as the CFPB. Their job is to audit lenders, determine whether someone has violated what the guidelines might be, educate consumers, protect consumers to make sure that every borrower is protected with whatever type of loan request they're looking at. The Consumer Finance Protection Bureau works on all sorts of lending environments. It works with the credit reporting agencies, the mortgage industry, the payday loan industry, car loans, credit cards, et cetera. So it has an umbrella and a connection with pretty much anything that's financial lending. We also decided within that Dodd-Frank that there should be some parameters about what would be considered a qualified mortgage. And again, at the basis of every loan request is the decision, do we think we're going to get repaid? And prior to Dodd-Frank coming into play, there were not nearly as many specific guidelines as to what a lender had to abide by. And so along with that, of course, comes the disclosure. And that if you've applied for a mortgage or you're working in that process, we're required as a lender to give you upfront, within a certain amount of days, an estimate of what it's going to cost you to obtain that mortgage, so that you can, one, understand what monies you're going to need to provide as well as what the risk is. At the end of the process, we're going to also be required to give you a closing disclosure that's going to be your final numbers. Now, again, we recognize those are fairly new terms to us. We call that initial disclosure the LE, or the loan estimate, and then the closing disclosure is referred to as the CD. All of these things have very specific time frames that go with them. So again, whether you're sitting towards the front end of the process, whether you're towards the back end, understanding that when we have timelines to meet, it requires each of us to do our part to move that file along so that we don't put our lender at risk. So now we've got a borrower that says, hey, I need some help getting a mortgage for my home. Either I'm purchasing a home or I'm going to go ahead and refinance an existing mortgage that I have. I know I want the house. I know I already have the house. How do I know what loan program I should use? Well, this is where our loan officers come in and our loan originators with their experience and professional understanding of how to walk a borrower through, asking some questions, helping them look at some different calculations as it relates to repayment, and give them some thoughts as to how they can successfully meet whatever is important to them. Certainly payment tends to be important for many of us, but that oftentimes is not the only consideration for a borrower. Maybe they know that they're going to be relocated in a few years, so they might choose a different type of program than if they believe they're going to move into the house and stay in there for the next 15 years. So there can be some other vehicles that we may need to help a borrower look at. Most consumers only tend to look at going through the mortgage process maybe 4 or 5 times in their lifetime. So this is a pretty intimidating process when you're familiar with it, but if you don't do it very frequently, it certainly needs a lot of TLC. So in trying to help the borrower determine what might be the best loan program, we first have to look at the different types of loans that are out there. There are conventional loans and government loans, and the difference between those is whether or not there's been insurance in place and guaranteed by the government. Conventional loans are not insured or guaranteed by the federal government. Government loans are. Within your conventional loan type, there are 2 types broken within there, and it's based upon the loan amount that the borrower is requesting. Your conforming loan amounts and that conforming loan limit is reevaluated each and every year. Oh, thanks very much. Thanks for good feedback, Greg, on the volume. So let me see how this works, and I'll try to adjust it again, and let me know if you would. So your conventional loan fall into two categories: the conforming loan amount, which is reevaluated each and every year, and then beyond the conforming loan limit, which puts folks into non-conforming and usually generates some different pricing and as well as some different product guidelines. So that's the first thing that someone would need to work with the borrower on. The second thing is, within each type of loan, conventional or government, there are a variety of different types of loan programs. Now, fixed rate mortgages have been the most popular for the last 10, 12 years simply because they've been at an all-time low. And certainly, consistency of payment makes it much easier for a homeowner to budget. So if you can take advantage of a low interest rate, more than likely you've chosen a fixed rate mortgage. There are a number of other types of mortgage loan programs out there that work very well for borrowers that have a need for them. One thing that I would remind everybody of as we look at all these loan programs, with the exception of an interest only, they're going to be what we refer to as fully amortizing, meaning that if your borrower takes out a 30-year mortgage, that at the end of those 30 years, those 360 months, that loan will be fully paid off. Not only will the borrower have paid all the principal back, but they will also have paid all the interest back. So fully amortizing is a key component in today's environment as to one of the things that came out of the Dodd-Frank. So when we talk about insured, and let me go back there to just kind of give you something to think about. So what do we mean when we say that those government loans are insured? So within the FHA program, for example, which is administered by HUD, again, Housing Urban Development, another acronym, your FHA loans have mortgage insurance included in them, one that will help protect in the event of default. The government stands behind those in the event of a default, that it would, similar to what private mortgage insurance does, it would help reimburse the lender for their exposure. So an FHA loan is backed by the government, just like a VA loan, which is eligible for veterans, that is backed by the government. Unlike your conventional loans, where the lender, unless they have mortgage insurance behind it, has exposure to whatever amount they've gone ahead and given to the borrower. So just a little bit of clarification as to what that insured term means. And again, no question it's too silly. This is one of the ways that we all learn. Most of us, a lot of times, have had to learn the business on the job, trial by fire. And so if you're in that role and just trying to get a better foundation, or if you're joining us because maybe you're moving into a different role or brand new to the mortgage industry, welcome. Fixed rate mortgages. What do we know about them? Well, the interest rate doesn't change. Very popular, and again, it fully amortizes. And by far, borrowers like to know, what's my payment going to be every month? I don't want to have to worry about it. There are also, particularly if rates start to rise, you'll see more and more offerings and more consideration for adjustable rate mortgages. Now again, in a low interest rate environment, you're not seeing them used very frequently. However, if I know that I'm going to buy my house and be relocated 3 years from now, I don't really need a 30-year fixed rate mortgage because I already know I'm not going to be there. So maybe I would take advantage of a 3-year ARM, meaning that it's fixed for the first 3 years and then it starts to adjust, and I'm going to get an even lower interest rate than I would if I did a fixed rate mortgage. So there's some benefit to considering these different loan programs based upon what you know about how long you're going to be in the home and what your needs are. So when you're looking at, again, not only whether the loan is, whether you're going to do a conventional loan or a non-conventional or a government insured loan, you're also going to look at which loan program is going to be the most beneficial to me. So we talked about within conventional loans, them being divided into two categories, either conforming or non-conforming. So each year, Fannie and Freddie, which are the primary secondary marketing agencies will evaluate and determine what the conventional loan limit is. And for 2017, if my memory serves me correctly, the maximum loan amount to be considered conforming is $422,100 across most of the country. If that is your conforming loan limit in the marketplace that you live, and a borrower comes in and applies for a $450,000 mortgage, now they have to abide by the non-conforming guidelines. And there's usually a little bit of a difference simply because bigger dollar amount, more risk. So again, the difference between conforming and non-conforming is driven by the size of the mortgage request. Quick look at an adjustable rate mortgage. And simply because, again, there's a lot of forecasting out there. At some point in time, we may see interest rates rising. There are also many times, particularly when we see borrowers looking for jumbo programs, or if you work in an environment where you may put loans into your own portfolio, that many times financial institutions will offer different types of adjustable rate mortgages. It may be an adjustable rate mortgage that's fixed for 5 years. These are some of the parameters that when someone's looking at an adjustable rate mortgage, they need to consider beyond what the interest rate is. How much can it adjust each time it's eligible to adjust? How much can it adjust over the life of the loan? How frequently will it adjust? And what's the rate that I'm going to start at? So those are the parameters, and again, that's all laid out in the disclosures. It's all part of the note that you would sign at closing, very clearly identified, as well as how are they going to know when it's time to adjust my interest rate? What is it going to be based on? And there are different indices that are used in the mortgage industry. So again, an adjustable rate mortgage isn't necessarily a bad thing. Certainly, if it's fully amortizing, you're going to pay that adjustable rate mortgage off at the end of 30 years, just as you would a fixed rate mortgage. The difference between the two is whether you know that you may only need to hold that for a certain period of time and go from there. All right, I'm getting some feedback that we've got some audio problems again, so let me try something different.
How's that? Is that any better? And thanks for the feedback, you guys, because there's nothing harder than that. Okay, good. Let me work with this. So once we get the borrower's loan program figured out, then, of course, we can get them started with the process, which is taking their loan application. And I mentioned before, and you'll hear it over and over again if you're new to the industry, the loan application is and always will be the most important document in the loan file, because that's the borrower's story. If you were going to lend me money and you didn't know me and you asked me to, send you some reasons why you should lend me money, it would probably be very similar to what we ask about on the loan application. Have I borrowed in the past and did I pay it back? Do I have the ability to pay you back? How stable is my income? How long have I been earning that kind of income? Am I new to the area that I'm living in, and did I just relocate, or have I worked in that industry and in the same marketplace for a long time? Then we also might want to consider, what are you going to use for your down payment? Did you borrow that money? Did somebody give you that money? Is it money that you've saved? Because again, when we think about risk, if I saved my own money and used that to buy my house, then I'm not likely to default on that, because I'm going to lose not only the house, but also the money, my own money that I put into it. And of course, last but not least, if we haven't ended up being able to foresee what might happen to the borrower over the life of the loan, we certainly take their subject property as collateral, as security. So again, as a lender, we're very interested in the subject property, and of course we use the appraisal to help us understand that, because we're taking that as a piece of security that we may need to sell in the event the borrower can't repay us. So I have a question about an adjustable rate mortgage. So in our example, we were talking about a 1-year adjustable rate mortgage, which would adjust each and every year. And if you were to choose an adjustable rate mortgage, the start rate on that is usually very, very low because of the fact that it's going to adjust each and every year. Question is, how much notice do you get? Is it a big surprise? It's written and within your note that typically you're notified, I want to say, and again, it could vary a little bit within the notes, but a good 3 to 4 months, if not maybe even a little bit longer, what the new interest rate will be at the point in time it adjusts. So you're given plenty of advance notice. And the other thing with an adjustable rate mortgage, if I had you sitting here beside me, and let's say you were going to do a 1-year adjustable rate mortgage, I could calculate for you what the worst case scenario would be each and every year. And then you could compare that to what you might be looking at with the fixed rate, and then you could make some determinations about what was a better option for you based upon how long you might think you're going to be in the house. So again, point there is that there's a lot of different loan programs out there. If you're in the role of working with borrowers directly, helping them determine that, borrowers are not always going to realize that there are other options out there. They tend to ask the first question and the only question being, what's my interest rate? But they don't realize until we start to listen to them that they may have some other issues that are equally as important. So let's look at this loan application a little bit closer. And we are not going to go through this, heavens forbid, box by box, but I would reassure each and every one of you that there is a reason for each one of these fields on this loan application. So if you ever have a moment where you think, oh, I don't feel like filling that out, that information can and oftentimes is needed in order to really make the best decision for your borrower. So the first section, and again, you can see these are set up by Roman numerals, talks a little bit about what kind of mortgage are we getting. The second tells us all about the property. Whether you're brand new to the business or whether you're a seasoned veteran, whether you've been underwriting for a gazillion years or whatever role you are in, everybody can participate in ensuring that we have consistent information within all the documents within the file. Starting with the property address. If I've got a purchase request, then I want to make sure that the property address on the loan application matches the purchase contract, matches the appraisal, matches the title work, et cetera, and anywhere that it doesn't, we need to raise our hand and say, hey, we've got a problem. Because again, remember what the process is about of processing and underwriting. That's simply verifying and validating this story on the loan application with third-party evidence. So we want to try to get that story right as quickly as we can. This tells us what type of transaction, purchase, refinance. Is it somebody's primary residence? Is it an investment property? Again, that will indicate different pricing, different guidelines, different maximum loan amounts, etc. Borrower information. This is where I would remind everybody, really confirm with the borrower, because again, a lot of folks are more interested in at least getting their application process started online, but make sure you ask them and reconfirm some information with the borrower, starting with, is the name that you've indicated on the loan application how you're going to sign the legal document? Or did you give the name that you're most commonly known as? Now again, we can use a name affidavit, but if the borrower has given us a name that is not their legal name, or if they are a junior and didn't indicate it, again, it can cause a lot of problems when we're trying to pull the credit report and again go out and verify information. So that's an area where we can always be helpful, and many times we just need to prompt the borrower to stop and think about that. 2-year history as to where the borrower's been residing, as well as a 2-year history as to what the borrower's been doing for employment, is a requirement for when the loan's going to be sold into the secondary market. So again, we're going to talk about using automated underwriting systems that you may be able to get a result from that automated system without having that 2-year history listed on the application. But remember, at some point in time, somebody's going to have to go back to the borrower and get that information. And early on, if you haven't already figured it out, the thing that irritates borrowers the most is us going back to them later in the process and asking for additional documentation. So hopefully if we can get you familiar with some of the reasons today behind why we ask for these different pieces of information, it'll help you realize and assure borrowers that this really is going to help make this process a little smoother. Section 4 is all about, again, that employment history. Are they self-employed? Do they have a full-time job and a part-time job? Do they have a full-time job and then they also have self-employment? Again, it can be a variety of a lot of different things. Maybe they have been out of the workforce. Maybe they've recently completed college. All of that still needs to be included so that we build the most recent 2 years employment history. Self-employed, and I want to point everybody to that very little box right there. That is how your automated underwriting system and everybody else that picks up the file after you've touched it understands whether we need to evaluate and document that borrower is self-employed. So very important that we remind ourselves and ask some of these questions, not only about all types of income, but certainly about self-employed. And you can see that last question there. In the residential mortgage world, a borrower is considered self-employed when they own 25% or more of a business. So if you ask the question and the borrower says, yes, I do own 25% or more of the business, then we need to be checking the box that we just looked at on that section. Can they have ownership in a business and own less than 25%? Sure. In our eyes, we don't document them and consider them as self-employed. Listen closely when you're visiting with the borrower about how they're paid, what they do, because they'll give a lot of cues as to the stability of that income. And this is a very, very, very important concept right here as we look at completing how the borrower is paid. The more that you can break it out in detail in your loan origination system, the more success you'll have in, one, letting the automated system direct you as to what you're going to need to get for documentation, and two, the better able it's going to be to give you an accurate recommendation. So again, if your borrower is paid, if your borrower is self-employed, let's say the borrower does meet that definition of 25% or more ownership in a business, then when you come in here, where do you put their self-employed income? You put self-employed income right here on the baseline. Okay, self-employed income in this section of the loan application should be listed on the base employment line. The system knows that self-employed income because you checked the box on the previous page. Break it out. Even if the borrower has to estimate it until they bring you the documentation, it's always helpful to try to nail down the different types of income that your borrower is going to rely on to repay us. Over here, when it is asking for housing expenses, present housing is always the borrower's primary housing expenses. So whether the borrower's purchasing a primary residence or whether the borrower is refinancing their second home, when we complete the loan application, or you take a look after the borrower's completed the loan application, present is always referring to your borrower's primary housing expense, even if they're living with mom and dad rent-free. Proposed is going to be for your subject transaction. In this example that we'll follow this loan application, these folks are purchasing a new primary residence, and they're going to sell their old primary residence to get the funds to go there. Okay, so if I had a borrower that was self-employed for their, let's say they were salaried for their regular job. I'll use myself. Let me use myself because this is my case. I work at MGIC, straight salaried borrower. So if we were going to go back here and take a look at how we'd complete this section of the loan application, we'd put MGIC in here and how long I've been on the job. And then down here, we would put that I have my own little business and that I'm self-employed. Okay? That's exactly what we would do for somebody that's salaried as well as self-employed. And then when we got over to the employment section, what would you do? you would take my income from MGIC and my self-employed income and put it all in base. And then, within the file somewhere, you would have calculated my self-employed income. And so we would understand that what you included as base is a combination of my salary and my self-employment. But desktop underwriter or even loan product advisor would know to condition and ask for the documentation to go along with both documentation sets. One of the things we want to try to do is, if you're going to use the other section, make sure you take advantage of the detailed options that your loan origination system has there. If you just pick other as a broad category, then the automated underwriting system is going to give no direction other than to make sure you follow the selling guide. And most folks don't want to have to go look anything up if they don't have to. So Roman numeral 5, we'll come back and take a look at some other things there. The next section, when you get into assets and liabilities, if you think about it, is really almost the borrower's own little balance sheet, shows what the borrower's assets are, and then we're going to take a look at what their obligations are. When, again, you're working with the borrower, some borrowers, they want to give you every bank account, even down to the one that's got $10 in it, and they insist on disclosing and giving you everything. Other borrowers, they don't want you to know any more than what you need to, and so if they're doing a refinance and they're not having to bring cash to closing, they may not even want to tell you where they bank. Remember, you may need reserves. It's always a good idea to just get a little bit of information about some assets in the rare event that you end up needing it, and then you don't have to go back and deal with it. Again, borrowers may come to the application or fill it out without having account numbers, et cetera, but we always need to list the institution where the monies are held, and I always encourage folks to list the type of account. If you know they've got a checking account here and a savings and a money market, list all of that so that somebody understands the types of account, and if we end up with duplications, we can try to figure it out. When borrowers own real estate, there's a special schedule that we'll take a look at that we detail what they have as far as real estate, and then that total is automatically moved into this section. Liabilities. Again, one of the most important things that each of us do when we touch the file. Many times you don't think about it because you order a credit report when you're working with the borrower, it automatically populates into this section of the loan application, and a lot of folks are like, well, it's got to be accurate. Not necessarily. Again, credit reports, good information, but there are times that a credit report might show a borrower's home equity line of credit as if it was a revolving credit card. Well, if you know that they do have a home equity line of credit, you may need to change in your loan origination system to make sure that we get the right liability type. So again, the credit reporting information is automatically fed into the loan application, but remember, it's also possible for a borrower to have an obligation that isn't reported to a credit agency. And of course, if you're going Okay, I should be back. Can you guys hear me again? Yay, yay, that was a test to see if you were paying attention. Good deal. Sorry about that. Modern technology at its finest. Okay, here we go. Thanks for being so patient with me and understanding that. You passed. Yes, you did pass. Now, one of the things we'll notice here is that we said that these borrowers that we're looking at their application, they're going to sell their current primary and use the money from that to buy their new primary. So, of course, we've got this current mortgage with the asterisk that's notating that that mortgage is going to be paid off either at closing or prior to closing. And then it would go on in there and evaluate the other obligations. Here's that real estate owned section. And this can get fuzzy as to what goes in there. Real estate owned. It should be real estate that the borrower owns personally. So if I own, in this case, these folks own their primary residence and they're going to sell it. If they own a vacant lot and they own it in their own names, great. If they own a vacant lot and it's in the name of their corporation, then it doesn't belong on here. So again, there can easily be some grayness that gets in here. We're really trying to identify what the borrower has personally. Now, my last thing here that I would remind everybody of is when you should or should not mark pending sale. And that's what that PS is saying. If you have a borrower like these folks that are selling their primary residence and then they're going to buy their new home, if we know that home has to sell, either because they need the money from that closing or they cannot qualify carrying that payment, then go ahead and mark it. As pending sale. Pending sale tells me and you and the automated underwriting system that it's going to generate a condition that requires this loan to be paid off in order for you to close your subject transaction. If your borrower simply has their house for sale and they just listed it and they don't know whether they're going to sell it before they close on your subject transaction or not, then don't mark it as pending sale. Many times we get that confused there. Okay, Mary, I see your note there. Okay, I'm going to take a moment here to let some folks know that they need to dial back in again. Of course, they cannot hear me, but evidently I wasn't the only one that was disconnected. So if you can see that, hopefully they're going to get a sense of they've got that information as to where to dial in. Okay, so that's the real estate owned section. This is also where if you have a borrower that owns a rental property, as you're taking the loan application, they're going to tell you, oh, I rent it right now for $1,000, and that's what I receive every month. My mortgage payment on it is $750, and that includes all the taxes and insurance. It's escrowed. That does not mean their net rental income is $250. If the gross rent is $1,000 and their mortgage payment escrowed is $750, that does not mean their net rental income is $250. First of all, if they've owned the property long enough for it to appear on their tax return, we're going to evaluate the cash flow perspective from the tax return. If not, we always have to assume that there's going to be a little bit of a fudge factor because they may not rent that property 12 months out of every year. So again, your automated system as well as your loan origination system, it's doing a lot of these things that we used to have to keep in our head automatically for you. SFR means it's a single family residence. If you had a duplex, you might see it be abbreviated DUP. If it was a 4-unit, might go in there as a 4U. Some of the loan origination systems will put it in as multi. Again, sometimes with our acronyms, we don't do a good job of giving you a table of what the definition means. We just kind of let you figure it out as you go. Details of transaction. Now, this is a really critical piece because this tells us how much our borrower needs to bring to the closing table, as an estimate at least. So if you have a borrower, let's say, that's buying their first house and they are, barely going to have enough cash to go to closing, these dollar amounts, the more accurate that we can make them, the better off we are, because not only are we needing to verify the monies that the borrower needs to bring to closing, as well as what they put down as far as a down payment if it's a purchase, we also may need to verify some reserves. So money is a big thing. Okay, good deal. We've got some folks getting back on the call with us. Glad to have you back. Declaration questions. Again, if the borrower has done their best to complete the loan application themselves, please go back through and re-verify how they've answered these questions. There are several that borrowers will have a tendency to read more into it than they need to and answer yes when in reality it should be no. So again, this just gives us, again, an idea of what type of financial issues, if any, the borrower's had. And of course, we know that there's certain time frames that if they've had some negative events occur, had to declare bankruptcy, they've got judgments, et cetera, that they may need to have a waiting period before they can get another mortgage after that last negative occurrence. Last but not least, if you have ever got a dull moment, you can sit down and read all of this language, which tells the borrower that when you sign this, we believe this is truthful. And if it's not, these are the types of penalties that you are exposing yourself to. So again, we're serious about this because we're lending somebody a lot of money. And back to the regulation conversation, this last section, which is all pulled together for HMDA reporting, is to help your financial institution and your lender demonstrate that they indeed are abiding by a lot of these different regulations. Now, we took a look at this loan application. One thing I'm going to tell you to store away is that come January of 2018, the loan application format that we looked at is scheduled to be changing in the mortgage industry. So stay tuned. I'm sure you'll hear more about that. But the loan application, the form itself has been redesigned, and we're going to see that implemented, at least it's scheduled for the beginning of 2018. Loan file checklist, again, just a generic tool for folks to kind of make sure that they've thought and gathered the documentation that they might need. Now, processing the loan. And everybody needs to consider themselves as part of the process, not just the person that wears the title of I'm the processor. Because whether I'm the loan officer, whether I'm the loan officer assistant, whether I'm the underwriter, we all take on that responsibility together to evaluate the borrower's story again. And processors, through the processors with the title on their head, wear a lot of different hats. They end up being almost like Malcolm in the middle, because on one end, they're trying to answer questions from the borrower and the loan officer, and on the other end, they're interacting with the other folks on the operations side that are going to be oh so key in getting the loan cleared to close and go to closing. So they've got to wear a lot of different hats, know a lot of different information, and processors oftentimes end up moving on and becoming excellent loan officers, as well as oftentimes move on to underwriting, or they like to be the mentor to new folks coming on board. So let's talk a little bit about this. We went back to this slide, which is the 4 C's, which are the basics of really any kind of a loan decision. And we know that we utilize, and I've referenced already several times, the automated underwriting systems. A couple reminders. Now again, why did automated underwriting come into play? Well, first of all, anytime we can utilize technology in the world, we tend to see that as a potential to make us more efficient. And it certainly did that in the mortgage industry. We also want to take advantage of the data that we can have an automated system process. And when you think about the guidelines that we're forever referencing in our world, these guidelines have come from statistically looking at when loans successfully repaid and when they didn't, and then putting some of those ideas as a guideline. The automated system is able to evaluate your borrower's request against the millions and millions of loans that have gone through there before and give us a recommendation. Note, I said recommendation. That's twofold. Let's look at a desktop underwriter recommendation. And of course, desktop underwriter is Fannie Mae's automated underwriting system. It turned 21 years old last summer. So again, I'm dating myself, but when you submit your loan application or a borrower's request into desktop underwriter, it's going to evaluate that information and come back to you with this set of findings. You'll notice that the response is referred to as a recommendation, and it's going to be two-step. The first piece of that, in this case the approve, is giving you information about how does your borrower's credit risk, all those 4 C's, stack up against others that have gone before. And approve, of course, is a favorable risk position. The second part of your recommendation, the eligible, is giving feedback as to, based upon the loan to value, the type of loan, et cetera, does it appear that this loan would be saleable into the secondary market? So you can understand the importance of an approve eligible. The automated systems, Fannie or Freddie's, have never approved or declined a loan. That is very, very, very important for folks that are relatively new to the business to realize and accept. There may be loan programs that say unless you get an approve eligible, you can't use this program. But the systems still need humans and the human beings' understanding of the risk, the guidelines, et cetera, to make that final determination as to whether it's a loan we can approve or a loan that we may need to ask the customer to either wait for a while or it's just not a good risk for us. So remembering that it's a recommendation, really, really important. Yes, approve eligible is good news, but there may be specific steps within these findings that say unless your borrower can meet this, this, and this, then this approve eligible is not able to be used. The other thing that can happen is that if we don't take very complete and accurate information on the loan application and then we submit the file to desktop underwriter, then it's kind of the garbage in, garbage out theory. So desktop underwriter is Fannie's automated underwriting system. Loan product advisor that we're looking at here on the screen now is Freddie's automated underwriting system. Loan product advisor had a retitling last summer. You may still hear folks refer to it as loan prospector or LP, but loan product advisor is Freddie's official name for that. And again, it too gives us a recommendation. First gives us a recommendation about the borrower's eligibility and about the borrower's risk as well as the eligibility. So again, we want to utilize those automated systems, but also appreciate that they cannot always see everything that we need to see as it relates to risk. So I'll remind you of a couple of those things when we start talking about income, et cetera. If you envision your file that you look at on your loan origination system all the time and all the different indices that break out all your documents, and if you were to imagine those all printed out, on the top of that file, when you're all done, would be this transmittal summary. That's referred to as the 1008. Of course, your loan application is referred to as the 1003. Your transmittal, which is simply a one-page overview, is referred to as the 1008. Again, like we talked about with the loan application, it breaks down different components of the file. Where it gets interesting to us as we think about, will the borrower likely repay, and do they meet the guidelines, and are we going to be able to get it sold into the secondary market, is right back here in this section, the underwriting section. This is where from your loan app, the system brings forward what was the income that was calculated, what's the primary housing expense, what are all the other obligations the borrower has, and not only calculates the housing ratio, but that back ratio, the debt to income ratio, that in many times becomes oh so important. So how do those ratios get calculated? Because you use them all day, every day, and you never really ever have to calculate them yourself because you've got a loan origination system that does it for you. So where do they come from? We've got two ratios that we typically will look at in the evaluation of a file and determining whether we can approve it. The first one being what we call the housing ratio or the front ratio. That's calculated by simply taking the borrower's primary housing expense, principal, interest, if there's a mortgage, taxes, insurance, all else. So of course, both Fannie and Freddie in today's world are referring to a payment on a property as PITIA, principal, interest, taxes, insurance, all else. So again, principal and interest, real estate taxes, homeowners insurance, homeowners association fees, mortgage insurance, secondary financing, et cetera, et cetera. You take all of that for the primary housing and divide it by the total income. And that would be an example down here. The back ratio, or the total debt ratio, or DTI, debt to income, is calculated by taking their primary housing costs plus all their other obligations, the student loans, car loans, credit cards, et cetera, adding that all together, and again, dividing by the income. So let's see what that looks like. Here's a 1008. The income for these folks was brought forward from the loan application after it had been verified. This is what their current primary housing cost is, and this is what their new primary housing is. And I know that because it's a purchase of a primary. So in order to calculate that housing ratio, they took the 1,470 and divided it by the income, and that's 16%. For the back ratio, they took not only the 1,420 plus the $985 a month of other payments and took that subtotal and again divided it by the income and arrived at the debt to income ratio of 27%. Now, what do those numbers mean? And sometime when you've got a minute, if you haven't, calculate your own housing ratio. Calculate your own debt to income ratio. And remember, what those ratios are based off of are the borrower's gross income. So for these folks, they've got 27% of their gross income already committed to paying their housing and their regular obligations. Not bad. But think about when we have a borrower that is bumping up against 40 or 45% as a debt to income ratio. That's telling us that we have 40 to 45% of their gross income already committed to just pay their basic obligations, let alone food, gas, all that other good stuff. So again, when we talk about risk, we can appreciate what those loan-to-value ratios represent. Now, we also have what percentage of the home's value the borrower is requesting to borrow. And that's where we take a look at loan-to-value, which is calculated by taking your loan amount and dividing it by the lesser of the sales price or the appraised value. So if you have a purchase transaction, you're going to calculate your loan to value by taking what the mortgage amount is and dividing it by the lesser of the sales price of the appraised value. So in this example, we're doing a 90% loan to value. That means the borrower's 10% is what they have as far as equity. That's kind of their skin in the game. When you have a home that's your subject property that has secondary financing involved, not only do you need to calculate the loan to value, but you may need to calculate the combined loan to value, CLTV, as well as the HCLTV. Here we go again with the acronyms. So what's a combined loan to value? We know we had a $180,000 first mortgage, but let's say, for giggles and grins, we also had a home that had a home equity line of credit against it, and that's what HELOC stands for, home equity line of credit. And a HELOC works just like a credit card. You have a maximum line amount, and then you use what you need, pay it down, use it again, pay it down, use it again. So to calculate the combined loan to value, we're going to take the balance on the first mortgage and then the balance on any other mortgages, in this case $4,000, and again divide it by the lesser of the sales price of the purchase, sales price of the appraised value. The combined, the HCLTV is when you've got secondary financing that is a home equity line of credit where we need to look at, okay, what's the worst or the most that they can borrow? So it would be the $180,000 first mortgage plus the line amount, the maximum that they have available to them. And again, dividing that by the lesser of the sales price or the appraised value. Now, why do we need to know those and why do we calculate them? One, it's our exposure as a lender. The higher the loan to value, the higher the CLTV, unfortunately, statistically, the higher the risk and the higher likelihood of the borrower having difficulty repaying us. Now, are there folks that do high LTV loans and repay perfectly? Absolutely. But again, we're talking about statistics, what's typical across, all borrowers. So one, we know the higher the loan to value, the higher the CLTV, the greater the risk, which of course is why we see mortgage insurance being required, not only to protect the lender, but also to help the borrower get to credit sooner. We also then can evaluate what the equity position is. And as we think about taking this property as collateral, in this case where there's a home equity line of credit on it, granted, we're going to be in first lien position with our $180,000 mortgage. But when we go to sell that property, if we have to take it back, we're going to have to deal with all this other stuff that's the guideline. So the question about standard loans to value, and again, many times you'll see a variance. If somebody's doing refinances, you may have very low loan to values, particularly if they've lived in the home for a long period of time or it's had a lot of appreciation. So loan to values can range from, again, as low as, in a single digit, which would be very atypical, up to 97%. So documenting the file. So before we get to calculating those solid ratios, we have to put all the documentation in the file to support that the income that's going to build those ratios is verified and as accurate as we can. So there's a couple different ways that we can document the file. We can get good old-fashioned standard verification, which is sending out a verification of employment to employers, sending out a verification of deposit. Those are still done electronically in today's world as opposed to waiting for them to come back in the mail. Also, we're commonly using, of course, electronic documentation, things that the borrower has access to, but still originated from a third party, pay stubs, W-2s, bank statements, all that other good stuff. Third-party verifications. Things that companies that have built the infrastructure for them to verify employment information, income information, asset information. There are vendors that do that. And so rather than an employer having to deal with somebody calling and doing verifications over the phone, they have instead signed up with the work number, for example, and they do all the verifications. Again, with the ability to transmit employee information safely so that they can do that. So documenting the file. Again, don't ever underestimate the value that you bring when you work with the borrower initially as well as through the process, because the folks that get to interact with the borrower, even if you don't ever get to meet them face-to-face, you will always, in my opinion, know more than anybody about the borrower's story. The challenge sometimes is realizing that some of the casual comments that the borrower made may be pertinent to trying to make the best credit decision. So let's break down these 4 C's a little bit in more detail. First of all, credit history. Borrowers are evaluated for a residential mortgage on more than just what their score is. Because we know and we hear stories, and there's all sorts of urban legends out there about somebody having a really great score and they have virtually no credit, or the exact opposite, tons and tons of credit, and for some reason the score is still sticking in a lower spot. So we have to appreciate what credit scores bring into it, as well as just good old-fashioned, what is the borrower done in the past when they have borrowed and what types of obligations have they taken on. So again, there's no doubt about it, as you see there at the bottom of the slide. Past credit history is a big indicator on future performance. If people have had some one-off situations, certainly they can recover from that. But again, a lot of times it becomes habitual. Like so many things we've already talked about, there's different types of credit, broken into really traditional and non-traditional. The vast majority of residential mortgage applicants will be using traditional credit, meaning that you can request a credit report and all the different places they've borrowed in the past for their existing mortgage, car loans, credit cards, student loans, et cetera, is going to be coming back to you on their credit report. There is a segment of the population that falls into the non-traditional credit category. May have always paid cash for whatever the reason is. They still, too, are eligible to be considered for residential mortgages. We simply have to go about documenting their successful repayment history a little bit differently, maybe using some alternative resources like you see there. A lot of you may ask your credit reporting agency that you have a relationship with to build that non-traditional credit. Some of you may choose to ask the borrower to bring you those utility payments, et cetera, directly. So there's different ways to end up documenting non-traditional credit. One thing that is important to realize is that even your automated underwriting systems like Desktop Underwriter can now generate a recommendation for a borrower that does not have any usable credit score. So in the past, where the lack of a credit score didn't allow the automated systems to be as helpful, in today's world, they figured out how to build that algorithms into the automated system to help out with that. So how far back do we go for credit histories? In terms of evaluating, in terms of how far back your credit report will go, as long as it's reporting out there, it's going to continue to pick up the trade line. And where do those trade lines come from? And where does that information on your credit report come from? Well, you got to think about it. So if you go into, let me say Macy's. I go into Macy's and I take advantage of the discount if I open a store card. And I open a store card. So Macy's then is going to take the information from my application, and then periodically they're going to report up to the repositories that hold all of my credit information. And there's 3 primary repositories across the country. Macy's reports to all 3 of them. You may have credit with some folks that may only report to 1 or 2 of them. That can be one of the things that contributes to the variance between credit scores that we sometimes see. The information gets to the repository from whomever you have borrowed money from. Then the credit report that you actually see in your mortgage file is put together by the credit agency that your lender works with, having gotten the ability to pull the information about your borrower down from the credit repositories, and then what they do is they put that in a nice, pretty credit report. And along the way, there's, of course, different types of credit reports. Okay, so if you're looking for where the link is for the presentation, if you go all the way up into your chat panel, you should see towards the very beginning that link that will take you out there, and that's where you can track it. Do you need to print it? I'm going to leave that up to you. There are quite a few slides, so you may want to save it and put 2 to a page or something like that. Okay, different types of credit reports. The most common type of credit report that we will use in the residential mortgage world is what we call a merged credit report. So let's take me. I come in and apply, and you're going to pull a credit report, and then you're going to automatically have it populate onto my loan application. Your lender has set up with XYZ credit reporting company that they're going to pull the information from the repositories, and then they're going to take all my different accounts and they're going to list them on my credit report once. So if my Macy's card, for example, reports to all 3 of the repositories so that it's available on a national history, then on your merged credit report, my Macy's account is only going to appear once. So what the term merged credit report is about is that your local credit agency has done some of the work for you, and that you're not going to see your Macy's account, for example, report 3 different times. It's only going to appear once, and that's the beauty of using a merged credit report. Those are most commonly what we see used in the residential mortgage world, and your automated underwriting systems will read those. On a rare occasion, let's say you have a borrower that has a lot of contradictory credit information. The borrower is saying, well, I paid it off, and the credit report is saying they didn't, or maybe a lot of duplicate credit, but can't really decipher what's going on. You may see the request to obtain a full factual, or what's also referred to as a residential mortgage credit report, an RMCR. And the difference between the credit report at the top and your merged credit report is that your merged credit report, nobody's gone through and called Macy's and called Kohl's and verified the information. When we ask for a full factual, like we see here at the top, before that report is sent to you from your credit agency, someone at the credit agency actually goes out and verifies that information. Okay, so a question has been asked is that if I'm going to apply for credit, is there a way for me to find out whether they report to all the repositories or whether they report to just some of them? I don't know that. I can't imagine that there isn't a way to find out, but I certainly can't imagine that at the point of application with whomever is helping you make that application, that they would be familiar with that. So again, it's quite common in today's world, given the use of widespread use of credit histories and credit scores for creditors to report to the repositories. It's also becoming much more common for renters. If I live in an apartment, for my apartment complex to maybe go ahead and be reporting to the repositories, where before that was very uncommon. But people know that they're looking for that history of how they've handled their obligations. Now again, technology brings us the ability to try to streamline things. And so credit scores were developed rather than everybody sitting around and forming an opinion about what that credit history looked like. The different repositories have pulled together their parameters and generate a score so that we can take a quick glance and go good, bad, maybe we need to look at that. So credit scores, you can see, have a range. The higher, the better, and theoretically the lower risk. Each of the repositories has their own score that you can see what it's called. There are alternative options out in the marketplace. Vanguard is one that you may have heard about. It has not been adopted yet within the residential mortgage industry. So credit scores have been out there far longer than we've used them in the residential mortgage industry. Credit scores that might be generated when you apply for a car loan will be different than the credit scores that would be generated for you when you apply for a mortgage, or when you individually say, I want to check my credit scores. So there's reasons many times, not only as to why the scores fluctuate, but in what circumstances. And they fluctuate differently because if I'm building the model, let's say I'm the lender and I'm the industry, and our industry is residential mortgage lending. When we build what goes into our credit score model, it might be different than what a car lender is interested in. So there is the ability in different circumstances to customize the parameters. Now, things that go into a credit score: what types of credit do you have? How well have you paid? Inquiries have a very small impact on your actual credit score. How much credit do you have? You know, are you at the maximum amount on all your credit cards, or are you using and paying them off monthly? So there's a lot of different reasons as to the fluctuation in your score. as well as just the whole timing of it. When we pull somebody's credit report today, it just kind of gives us a snapshot of what it looks like on that day. What if I paid my cards off tomorrow? Well, then you wouldn't know that. So again, we have to realize that there's a lot of moving pieces when it certainly comes to credit histories, credit scores, and documenting that. Quick walk through these two folks that we've been looking at their loan application, and now we're going to use their credit report and other documentation. While each credit agency has the ability to format their credit reports based on what your preferences are or what they decide to do as a company, there are still some required components in every credit report. Some of them by law, some of them be based on the industry. So first of all, if you're looking at a credit report, it will be required to tell you how many repositories were requested. So at your local relationship with your credit agency, when you set that up, was probably determined that they would automatically, when you order a credit report, try to pull all 3 repositories. That's required, just like it's required for there to be an indicator to the unique file number for every credit report. And if you ever notice, when you look at Desktop Underwriter and Loan Product Advisor, it will, in their recommendations, where the results come out, it will reference the credit report number that it used to generate its recommendation. Get information about the borrower. And of course, again, you know, I pulled a copy of my own credit report and they had my name spelled like 8 different ways. Well, I know how to spell my name. Again, how does the information get up to the repository? It gets up there from the creditors that I've done business with. Maybe they can't type, and then my name gets up there with a lot of different aliases, so to speak. So now we've got scores. In our example, we had 3 repositories that were requested, and a score came back from each of them. So now comes where we need to get into understanding what is the indicator score for each of our borrowers, which if you have 3 scores, then the borrower's middle score is referred to as the indicator score, kind of like smack dab in the middle. Once we get the indicator score, and again, the indicator score for borrower number 2 is really 742. So for borrower number 1, the indicator score is 720. That's the middle of the 3. And for borrower number 2, it's 742. Now we want to recognize what is the representative score for the file that will be used to determine pricing, loan to values, other factors that will impact what we can do for the borrower. So the representative score is calculated by taking the lowest of the scores that you've identified for the borrowers. If you've got only 2 scores, then instead of using the middle, you use the lower one. And if you want to read all about that, we've got lots of direction as to how you calculate those scores. Folks having their identity stolen or their credit compromised is a huge problem, not just for folks applying for a mortgage, but you will find in most credit reports there's going to be a section where if the borrower has had some fraudulent activity or has had some concerns or has decided to freeze their credit, that you're going to be able to see that information, and that needs to be taken seriously, but also understand that it can be used to help offset what appears to have been misuse of credit. Public records. We talked about a merged credit report where it takes and only lists the information once. Very difficult to do sometimes when public records are available on a borrower's credit score, simply because they're not always identically listed in each of the repositories. And so this may be an area when you're working with the borrower and or processing the file that we need to ask for additional documentation to understand, is this still outstanding or what's happening with it? And then when you've got an individual trade line, you've got the mortgage, et cetera, not only does it give you the account number, it shows you whether this obligation was obtained individually or jointly. shows us when it opened, when it was last updated, what the high balance was, in this case what the high balance of the mortgage was, what the payment is, and then have they repaid successfully. And again, there can be a lot of different ways that that'll be formatted, but that's some of the basic information that comes into my Macy's account, my mortgage account, etc. Now let's talk about inquiries, because again, there's a lot of lore out there about what happens when there's inquiries present on a borrower's credit report. There's two types of inquiries. There's what's referred to as a hard inquiry, which means that you as the consumer have signed and acknowledged that, yes, I'm giving permission to for someone to pull my credit history and subsequently probably pull my score. It will affect your credit score, as opposed to a soft inquiry, which is done maybe without you acknowledging it indirectly, maybe at the time you do authorize a background check, or maybe if you're applying for a job, or soft pulls are done when you get those credit card offers saying, hey, let's give you a new credit card. Those soft inquiries do not impact the credit score. How significant do inquiries impact a borrower's credit score? Very minimally, according to a lot of information and studies done by the credit industry. One thing that I could not encourage all of you more is to stay away from acting as a credit counselor. Friends, family, because you're in the mortgage industry, they will automatically believe that you can give all sorts of great advice. When it comes to helping folks figure out what's impacting their score and how to maybe address that, leave that to the folks that are in that business. And please remember that there's been many folks that thought it made sense to close all of their credit cards and were shocked when it reduced their credit score. So we need to be very careful of giving advice in an area that we don't have control over. So just kind of think back about the credit report. First question that you see there, does everything on the credit report line up with what the borrower told us on the loan application? And if we have conflicting information, then we don't want to say, well, I got the credit report, I must be done. We need to follow that through, because we all are concerned with making the best loan. Now let's talk about the fun part, which is income calculation. And there are so many different types of income that we can't possibly memorize what the required documents are for each type of income. So what's a better use of your brain cells is to understand and come back to, why are we worried about income? Well, it gives us an indication as to whether the borrower has even got the ability to repay it. And we gauge that by looking at what's their history, how consistent has it been, maybe how are they paid, and is it likely to continue? So here's a laundry list of a lot of different types of income, and it's broken into two categories, non-variable and variable. Variable types of income, over there on the right, we expect them to fluctuate. But because they have the ability to fluctuate, we want to truly try to figure out what's normal, what's typical. We don't want to qualify the borrower for their mortgage on the best year they've ever had and will have in their whole life. We want to qualify the borrower on what's likely to be available to them each and every year. And part of that is if you think about it, we close a loan, and if the borrower goes back to work and they get laid off, nobody goes and gets the money and say, oh, now you're laid off, we've got to take that mortgage money back. You're going to still trust that the borrower is going to be able to figure it out and duplicate that income. This is also where I want to remind everybody that while the automated systems can help us figure out how to document the income, and we're going to break down a couple of them, there's also places they can't help us. So let me just use an example of somebody that works for a family-owned business. Automated systems are never going to spit out a message and say, oh, hey, don't forget that your borrower works for family-owned business. It's going to be dependent on us learning the business, thinking about where the risk is, that recognizes that there's a greater likelihood statistically, we're not just suspicious, of folks that work for a family-owned business, but there's been a greater occurrence of borrowers that work for a family-owned business where the information has been manipulated a little bit to try to provide a more favorable outcome. So when we have a borrower that works for a family-owned business, the first thing we need to document is, do they have any ownership in the business, and if so, what percentage, so we can understand that self-employed thing. From there, we're going to document their income. If they simply are paid a salary, we're going to go out and get a pay stub and some W-2s, but we're also going to go beyond that and get their personal tax returns so that we, again, can evidence their source of income from a third party, the IRS. So somebody asked about Social Security, and that how do you verify Social Security for dependents is going to continue. And continuance is one of the things that we know with certain types of income, and really any type of income that has a finite end. We need to document that that income will continue at least 3 years going forward into the life of the loan. Now, first of all, why 3 years? Who decided 3 years was the magic number? Again, this is all done statistically in looking at if a borrower is going to struggle to repay, it oftentimes is in the first couple years of the loan. So that's where that 3-year window comes from. So if I'm receiving Social Security, here's a question for all of you guys. If I'm receiving Social Security on behalf of my sister, and my sister is 17, is that income going to continue, and would we be able to use it for qualifying? So that's where you're going to use the chat panel to help me out here. So here's the question. Yes or no? I'm receiving Social Security, and it's on behalf of my sister who's 17. When I come in and apply for my mortgage, can you use that income to qualify? No, because it's not going to continue. When she becomes of legal age, it's going to stop. How could you document that it possibly would continue? So is there a possibility that I might continue to receive that income on behalf of my sister? Possibly. Maybe it's already set up through the legal system that for whatever reason that money, she may not be able to make financial decisions independently. So even when she does come of age, that money is still going to come to me. So we'd have to go about documenting that. So again, there's some caveats there. There's that possibility. And it's the same type of consideration. Again, we get into that question. Let me go back here to this when we think about different types of income. Alimony or child support, it gets very gray when you have folks that are applying that are receiving child support. First of all, just because somebody's receiving child support, they do not have to use it towards qualifying. If they choose to, fine. We'll need to, again, along with the other pieces of documentation, consider will it continue for 3 more years. If the kid's 17, but the divorce decree says the child support's going to continue while they're in college, now what do? Do you use it? Do you not use it? Do you start trying to figure out whether the kid's got decent grades and is likely to go to college? No, you don't go through all of that. Again, it comes back to a certain extent, evaluating the risk within that file. So difficult sometimes for you to always get a black and white answer to your question, and that's okay, because that's just a reminder to you that you may need to ask some additional questions so that we can better understand the risk. So when you've got a borrower that's receiving a base, maybe paid by the hour, salaried, something that for a lot of folks, they think about, well, that's pretty straightforward. Again, we'd always love to have a 2-year history, but that's not always possible. If we've got base or salaried income, again, it's a little bit more straightforward than that variable income, and we tend to not need quite the extent of documentation. Again, we may need to just get a pay stub and either 1 or 2 years verifications or W-2s, and maybe a verification of employment. Usually one or the other will suffice. I want to remind everybody about any documentation, whether you're looking at income documentation, asset documentation, et cetera. One of the things that will happen very quickly in someone's career within the mortgage industry is that, one, we're always in a hurry. Two, we're trying to get something done fast so that we can get the file moved along. And three, we look at a lot of pay stubs, a lot of bank statements, a lot of VOEs, and so it's easy for our eyes to deceive us. Always make a point of when you are going to look at a document, whether you're going to calculate anything from it or you're just gathering the document, determine whether the document has all the required elements on it. Because if it doesn't, then you're going to have to go back to the borrower anyway or go back to the source. So with a verification of employment, again, one of the challenges sometimes with using verifications is that employers don't complete them very accurately. But also consider, does the information on the VOE support your story? What did the borrower's loan application say about when they started? What did it say about their position? What about the person that signed the VOE? Do they have the same last name as your borrower? That's a red flag. Not necessarily impossible, but it may suggest that we may not have enough distance between whoever completed the verification and what we would like to have. Pay stubs and W-2s, and again, like we talked about, we may also have some verification from that third party. Borrowers that have handwritten documentation, very atypical, of course, in the world today, although there are plenty of folks that are getting handwritten W-2s and handwritten pay stubs. So again, if you're presented with that, you need to check your program guidelines or where you're going to deliver that loan and see what their specific parameters are. Many times it's just to elevate to the next level. So where you may not have had to get tax returns when you've got handwritten ones, now you may need to get tax returns just because of the potential risk. Also, when you've got folks that are paid in this fashion, make sure that you don't make what still is a fairly common mistake, which is as you're looking at a pay stub, mistaking that a borrower's paid 26 times a year when in reality they're only paid 24 times a year. And this is just an example on this slide as to what doesn't sometimes feel like a big mistake. It's a $300 a month difference, easily somebody's car payment. And of course, we all understand, we describe that process where we make the loan and then we sell it into the secondary market. If we've made a mistake and the secondary market realizes that we miscalculated the income and now the borrower can't pay, they're going to send the loan back and ask your lender to repurchase it. So very important, even when we're looking at what some folks consider to be just the pay stub, there's a lot of moving parts on a pay stub, and very important that we understand the timing of how folks are paid. Commission borrowers. And again, folks can be paid commissions either with a W-2 or a 1099. Always helpful to get that identified up front. While borrowers may not know much else, they typically will know whether they get paid with a W-2 or a 1099. And that is important because, one, if they're paid with a W-2, you're going to need to get a sense of what percentage of their total earnings are from commission, because that's going to dictate whether you need their tax returns or not. If they're paid with a 1099, then very likely they've written off expenses, and you're probably going to need to look at their tax returns. So again, the more that we can ask and listen to what the borrower is saying, the better we'll be able to make this process not only for the borrower but for ourselves. So again, when we've got variable income, like we already talked about, we'd love to have that 2-year window to look at because we know that there's potentially fluctuation. If they've got some sort of variable income like commission and they've been receiving it for less than 12 months, it's not going to happen because it's not stable enough for us to know what's going to be available for us to get repaid. Remember, that's the only thing we're worried about as a lender is will we get repaid? Where you start to see a lot of gray with variable income is when you have borrowers that haven't quite been receiving it for 2 years, and then there's always that question of can we look at it, can we not? things to consider, again, are layering of risk. So what other factors do you have that are positive or negative beyond the fact that you don't have the required income history in the file? And that's going to always be a good indicator as to whether you can take a look at that less than 2-year history or not. So it's not a black or white answer, and we don't want it to be, because we want to be able to evaluate each borrower scenario independently. We've got other types of income that fall into the category, like Social Security does, of potentially being non-taxable. Now again, you can see there on the slide, non-taxable sources of income may be grossed up. They don't have to be. It's optional. In a conventional world, which is what we're talking about here, if you're going to gross it up, typically would gross it up 25%. The why we gross up non-taxable income is because, again, remember, I'm your borrower at MGIC. You're using my gross income before taxes. My mom, who comes in and applies and uses Social Security that's non-taxable, we want to kind of put her income in the same range, apples to apples, for us to make our decision. So again, if you're going to use non-taxable income and you're going to consider grossing it up, the very first thing you need to do is document whether all of it or what portion of it is non-taxable. Because remember, the only portion you can gross up is the non-taxable part. So what's that mean? Let's take a look at that. Okay, so I'm going to have to make the numbers simple here. So if I had a borrower that was receiving $1,000 in Social Security, let me make it even easier, $100 a month in Social Security, and it was all non-taxable, then I could take that $100 times 25% and use $125 for qualifying. That's what it means to gross it up, is that I'm going to take the amount they're receiving. Once I then document whether all of it or just a portion of it is non-taxable, then I'm going to increase it by the 25%. Gaps in employment. Again, the tip that I can give you in working with files that helps the most from our experience is when you have gaps or you've got a borrower that hasn't received their variable income for a full 2 years, is start a timeline. Get the month and date that they started their job, and then go backwards as to what they were doing during the gap and prior to the gap. Or get the month and date they started their commission job, and then let's look at how much documentation we can pull together before. And the same things that we talked about as we wrapped up credit are the same things that we're going to really wrap up here with income, which is, does it all align? Does the information that we verified match what the borrower told us? Are there any specific guidelines? And do we have a sense that whatever we're going to rely on to build the borrower's ratios is likely to recur? It's still a crapshoot in some respects because we don't have a crystal ball. But that's the point of all of this emphasis and agony sometimes of trying to document the income. It all boils down to, will we likely get repaid, and can we determine that based on the likelihood of continuance? So as we move off to assets, has anybody got any burning questions about income? And again, we do an income-specific session as well as an asset-specific session, and then an appraisal-specific session, because each of those, we could certainly spend a good bit of time on each of those. So I've got some questions about how do you get to the recording of this and how long are they available. We always keep a current recording up of each of a lot of our sessions, so they're available on an ongoing basis. So for example, with this fundamentals course, there will be a recording of this posted into the future. It's available 24/7, and you access it by going out to our website, mgic.com, and there's a tab that says training, And then if you just scroll down, it'll take you to the recorded sessions. So assets, we like to talk about money. And again, in terms of documenting the cash or the assets, typically it's with some sort of a statement, and we like to have a 2-year history. Beyond the cash type assets, or what we oftentimes call liquid assets, folks can also sell their real estate. They could sell their motorcycle for the down payment. But we need to remember that not only are we looking at the current value of that asset, but we also may need to look at where that asset originated. What was the source of it? And that's where we get into some more specifics of where did the money come. So if we're looking at an statement, and again, this slide is just reminding you, before you get worried about how much I have in my checking account, make sure that my statement or my verification of deposit has all the required elements on it. If something's missing and then we send that on to the underwriter, they're just going to send it back with another condition to get something else. So we want to try to take care of it ourselves, kind of own as much as we can, and then go from there. When we get this information in, where do we specifically need to look at potentially getting more documentation about where the money came from? When you've got a new account that has only been opened a short time, typically less than 2 months, we need to then trace backwards. Did the borrower just close an account and reopen at a new bank, or where did that money come from? As well as, we also like to take a little bit closer look at, as we go through the bank statements, where did any large deposits come from? Now, there's kind of 2 reasons that we look for large deposits. And those 2 reasons are, 1, if your borrower is doing a purchase and the loan program requires them to put a certain percentage of their own money into the transaction, well then, if the money was given to them, it doesn't really belong to them. So that's one reason we like to investigate large deposits. The other reason is, what if they borrowed the money and now there's a liability that we should be including when we calculate that debt to income ratio? So those are the reasons why we get into looking at large deposits, because certainly it can be a messy conversation with the borrower. We define a large deposit. Thank you for letting me know I'm cutting out again. I'm sitting very still, and I'm going to try to sit very still. We define a large deposit as a single deposit that's greater than 50% of whatever we end up calculating as qualifying income. So if you've ever had the thought, if you're a loan officer, of I'm just going to let somebody else calculate the income, not only can it impact your ratios, but income calculation can also impact what we have to document as far as assets. So it's important that we get all on the same page as best we can so that we do the smoothest job that we can. So that's what the definition of a large deposit is, and you can also see that you've got a little bit of leniency depending on whether it's a refinance transaction or a purchase transaction. You also can use from a deposit a portion of what you can verify. So let me give you an example. Let's say I'm your borrower, and on my bank statement there was a deposit that was just a counter deposit of way beyond 50% of my income. And you asked me about it as the borrower, and I said, oh, well, I got married, and that was the money that people gave us. And some of it was cash, and some of it was checks. Well, the cash, you can't really source cash, but I could use the portion of that large deposit that I could re-verify in the form of the checks. So there's definitely some different scenarios as to how you can break down those deposits a little bit if you're causing and having some problems with that. Gift funds. Gift funds are used in about 1/3 of first-time home purchases. So this is an area we talk about quite frequently. And again, a borrower can receive gifts for the down payment. They can receive gifts for reserves. They can receive gifts for closing money. So gift funds can be used in a variety of factors. We are in a conventional world, loans being sold to Fannie and Freddie, going to need a gift letter, and many times we just have a form that we offer out to the donor. The donor's got to give us their personal information, how much they're giving, that they don't expect it to be repaid, and then we also need to understand the relationship of the donor, and do they qualify as an acceptable donor. We also have to make sure that the donor has given the money, either already, maybe at the point of application, or that the gift money is going to come to closing. I would like to just mention that one difference here between conventional guidelines and government guidelines is that in a conventional world, the donor is not required to document where they had the money. So, example being, if my mom gave me a $5,000 gift, my mom would have to document, or I would have to document that she gave it to me, either at closing or already in my account. She would have to do the gift letter, but mom would not have to give me her bank statement to show that she had the money. A little bit of a difference there. The next thing I want to kind of go to is that I want to just have a quick conversation a little bit about reserves. And I want to remind folks that reserves can be required in a variety of different circumstances. So depending upon whether it's a purchase of or refinance, depending upon whether it's an investment property or a second home, depending on how many units there are in your subject property, and certainly depending upon the risk that your automated underwriting system sees, can drive whether you need to gather additional reserves or not, and how much. Fannie and Freddie also calculate reserves a little bit differently. Freddie typically calculates reserves by asking for 2 6 months of payments for whatever properties they're looking at, or reserves for whatever your current payment's going to be. Fannie will look at many times a percentage of the unpaid principal balance if it's asking for reserves based on the borrower owning other rental properties. So your sources for reserves, again, not just what folks have in their checking and savings account. They can use what they have in retirement accounts. Even a life insurance policy can be used as reserves. We talked about the first 3 C's, the ones that really involve evaluating the likelihood of us getting repaid from the borrower's perspective. What's their credit? What kind of income do they have? Where's it coming from? And what do they have as far as assets and monies of their own into the transaction? The 4th C is the one, of course, that kind of wraps it all up from the perspective of if for some reason the borrower is not able to repay us, what are we taking as collateral? Well, in a purchase transaction, that all starts with the sales contract, which, you know, binds the buyer and the seller together and lays out all the time frames. But what it also lays out for us as the lender is, are there any contingencies? Does it require any repairs to be made? What types of sales concessions are being given, and are those in line with what's permissible? So the purchase contract, while it can be many pages and tedious to go through, is obviously a critical part of legally getting that borrower to having ownership in that home. And then from there, we get the appraisal, which again, we talked about the loan application being the borrower story. The appraisal report is the property story. We're using that subject property as collateral, as our security. And one of the things that we want to understand from the appraisal report is certainly what's the physical condition? Is it habitable? Is there anything there that makes our subject property unsafe? And then how well does it fit into the neighborhood? We've got different kinds of appraisal reports depending on whether you've got a condominium or a single family. But as always, does the appraisal report support the value that the borrower, that the appraisers identified as what the market's willing to pay for it? And I just remind everybody, the appraised value is as of a particular moment in time, and the market could change, so therefore the borrower's appraised value could change, as we know that real estate values will ebb and flow. So we've taken a quick walk, a long walk through how we go about making this credit decision. And we've also thought about why we need to look at this stuff in as much detail, not to make anybody's life miserable, but because we are really needing to not only document it so that we can make a good decision, but document the file so that we can sell it if need be, and or demonstrate that we did our due diligence in coming up with the decision. Now, we talked a little bit about the insurance and the fact that the government loans are insured and that the conventional loans are not, and that's where private mortgage insurance comes in. And a couple things that I want to mention about private mortgage insurance is that it does benefit more than just the lender. And how it benefits the borrower, we're certainly seeing in today's market. I live in the Tampa Bay area, and property values are appreciating, which is great if you're a homeowner. Not so great if you're trying to save to buy a house, and all the time you're saving, you're watching the cost of your house go up. So not only does mortgage insurance bring some guarantee to the investor, the lender that's putting their money on the line, it's going to ensure in the event the borrower doesn't pay that they get some help with that. But it also can help the borrower in that it gives them access to credit sooner than if they were going to have to wait 5-6 years to accumulate that 20% down payment. So the reason that mortgage insurance is required, either in the form of FHA mortgage insurance or private mortgage insurance, is because of risk. And we talked, unfortunately, a little bit about that higher loan to value does bring additional risk to it. But the important part that folks are always interested in with mortgage insurance is, how do I cancel it? I don't really want it. How do I get rid of it? And again, how you get rid of it can happen one of two ways, like you see here on the slide. Also, there are laws that require mortgage insurance to be dropped on the private side when the loan amortizes down from its original balance to 78%. So again, there's two different ways that mortgage insurance can be canceled. One, it's going to happen automatically by law, and the servicer, whomever your borrower is making their payment to, will take care of that. Or, of course, they'd be subject to penalties. The more often way that mortgage insurance is dropped is that the borrower asking for it to be considered to be dropped. So first of all, if somebody's going to consider dropping a borrower's mortgage insurance, they're going to look, first of all, is the borrower making their payment? And if the borrower's not making timely payments, then they're probably not going to be interested or as interested in dropping the mortgage insurance. So that's one thing. The second thing is borrowers wanting to request cancellation need to go and get in contact with whomever they're mailing their monthly mortgage payment to. So canceling mortgage insurance is not up to the mortgage insurance company, and it's not up to the lender that made the loan. That decision is going to be made by whomever is handling the servicing of that loan in the form of accepting the payments and the escrows and all that other good stuff. So that's always a really good piece of basic information to know because, again, that is always invariably the first question people ask. So hi there from Naples. Glad you're here. So one of the things as we get ready to wrap up, we've got a couple minutes for some questions, although I'm not sure you guys have the wherewithal. I hope I haven't worn you out by all this information. But I'd also like to invite you, and again, we have a lot of different ways to connect with us. Pick your favorite social media platform and use it. We post and share information about the mortgage business in general, not just mortgage insurance. If you are in the world of connecting with your referral partners, please don't hesitate to utilize our content and share. That might make it a little bit easier for you to reach out to your referral partners and remind them that you're more than willing to help them when they need to refer somebody for a mortgage. So again, we cannot thank all of you enough. As we talked about, this is and has been recorded. There will be a posting out there if you'd like to go retrieve it. One of the things that folks always talk about with the recordings that they like is they can go find the section that they missed or they spaced out on and then can take a look at it. Questions that we might have from anybody. All right, so this is the time. If anybody's got some burning question that you would like us to all share with the group, we'd be happy to. Oh, okay. So the real estate owned section. Remember I made the comment about the real estate owned section when we were looking at the loan application, that we wanted to put real estate owned in there if the borrower owned it personally. And a couple of folks chatted in that they've been told that if the person owns 100% of the business, that we need to put those properties on their personal real estate owned as well. So let me give you an example. If I own a subchapter S corporation and I own 100% of it, and that S corporation owns a piece of real estate, since I own 100% of it, does it need to be included on my personal loan application? And of course, you know, I'm going to say sometimes yes, sometimes no. If there's a mortgage on that piece of real estate that's now owned by my business, and that mortgage is on my personal credit report, then more than likely I probably would put it in the real estate owned section because I want to tie that mortgage to that piece of real estate, and then I may actually go through and document that the business is making the payment. So again, depending on the type of business that they own and if they truly own 100% of it, that may be something that you want to take a look at. Okay, so I'm not sure if that's enough of an answer for you, but I certainly understand why there's some discussion about that. And I will tell you that we have different customers that handle what goes into the real estate owned a little bit differently from each other. So that's more than one way to take a look at it. Okay, you guys, thanks for all the really, really nice things. Truth in lending. You know, Andrew, I'm going to send you some information on that. APR is annual percentage rate, and it is the challenge of every mortgage loan officer to be able to explain to a consumer what the annual percentage rate is. And what the APR is it's very different than the interest rate that you're repaying on. But what the intention behind the APR being created as part of these regulations was to make it easier for the consumer to shop. That just shopping based on interest rate isn't necessarily comparing apples to apples, because lenders may have different costs included in addition to what I might be looking at from an interest rate. So the annual percentage rate is a blended number taking into consideration not only the interest rate, but a variety of other of the fees, and arriving at that APR percentage so that you could then compare lender to lender to lender and decide which was the best option for you. It's one of those, it's a great idea to try to help people understand what they're looking at, but it's very, very difficult for folks to understand, particularly if they don't do and talk mortgages all day long. Okay? Questions about removing mortgage insurance. And again, there are lots of provisions. You know, if a borrower, let's say they need mortgage insurance when they close the loan, but then they make a significant reduction. Let's say they sold a piece of property. Can they go ahead and ask for it to be dropped then? Again, as an MI company, we'll be happy to drop it whenever somebody tells us to. They need to go back to their lender and make sure that that's going to work. I've got some questions from several of you about some of the different regulations and some more specifics with that. I'm going to direct you, back to your lender, because a lot of our lending partners have modules, you know, maybe online learning, where you can get out and get some specific details and a little bit more background as to the regulations. I don't really have a good detailed piece to refer you to, and then take a look at that. Okay, I hate to do this, but we are actually running out of time, so I'm going to need to wrap us up. What's going to happen when I close out the session are two things. One, you'll have the ability to give us some feedback in the form of a brief survey. Please do so. And the second thing that will happen is you'll get a thank you email, and within that thank you email, it will have a certificate of completion showing that you did indeed spend a good bit of the afternoon with me. So if that could be of any help to you, we hope that you take that and get it into your employee file or load it into your learning management system so that you get credit for being interested in furthering your education. So on behalf of MGIC, we appreciate you taking the time, and we really are interested in continuing to build a partnership with you. And thanks ever so much for attending. Bye.